Good morning, everyone, and thank you for joining us. We're going to speak about cash flow management, which for most of us, at least at some point of our lives, I'm sure was or is a very important matter. Okay, here we go. So the importance of cash flow management. Cash flow issues can cause immediate financial trouble, including government intervention, right? So if we're late with our audit, if our financial reporting is not up to date, these are not necessarily good indicators of our financial management. But if we miss payroll, if we don't make payroll, this is when, it's a really bad thing for our financial independence. This is when we can get into intervention and all sorts of troubles. So managing cash flow is important for spending control, right? And then cash flow issues cause the most stress for organizations, their staff, and leaders. And I'm sure personally, for most of us, when we had to deal with cash flow issues, we know what that stress is like. And professionally, when working for our organization, cash flow issues is probably the hardest thing to deal with, because as much as we try to separate ourselves from our job, we still keep thinking about it, right? Like if we are in finance or in some sort of leadership role, and we have to ensure that payroll is paid on time and all the payments are made on time, and we know there's no money, that is very stressful. My husband just recently started a new job, and when he was going through the interview process, he asked me, well, what would be a deal breaker? Why wouldn't I take the job? And I said, you know what? If they have significant cash flow issues, this is a deal breaker, would be for me. Okay, so cash flow elements. When we track cash flow, when we think about it, it's very straightforward. It's just like us managing our cash or cash flow at home. So we have the current cash in bank, plus we have all the money coming in. So at work, it could be government funding, could be customer receipts if we're running a business, could be proceeds from some loans that we're getting from the bank. Then minus money going out. So this would be our payroll, our expenses, asset purchases, payments to vendors, and debt or loan repayments. Now, if we add all of this together, we get our expected cash balance after all payments and receipts. And this is our basic cash flow tracking formula here. So what are the main causes for cash flow shortage? They can be late funding or late customer payments, so our cash coming in doesn't come in on time. Overspending is a leading cause when we spend more than we receive in funding and sales. Significant prior debt to vendors. Sometimes we start working for an organization and we inherit prior overspending or mismanagement of cash resources, and there may be significant amounts owing to vendors, loans, so on and so forth, and that puts pressure on us when we manage our cash flow, because we're the ones getting phone calls and letters from vendors and their lawyers and collection agencies. There can be an aggressive debt or loan, right? So if our debt has aggressive terms and repayment terms, then maybe our debt payments are so high that they put stress on our cash flow. And then we can also have the opposite of that, which is ineffective use of borrowing from banks and within organization. All those bank loans exist for a reason, and one of the reasons is to help us out with our cash flow, so it's important to use them effectively. So here are some considerations for cash flow management. Just because we have profit, it doesn't mean our cash flow is good, right? Because For most of us, we use the accrual basis of accounting. We record accounts receivable, we record that funding or revenue from sales, while the money is not necessarily there. Money can come later. And the same with payments. We may be recording expenses in our system as of the invoice date, but fortunately, we don't have to make those payments immediately. Sometimes we have terms or good terms with vendors and we can pay later. So when we think cash flow, this is really money coming in and going out and their timing. It's not necessarily our profits. So I'm a fan of preparing cash flow projections or tracking on a regular basis. Even if your cash flow is good, it's good to know where you stand, right? Now, if your cash flow is good and you don't prepare your cash flow tracking, you're probably okay. But if your cash flow is short, if it's not a good period for cash flow, it's imperative that we prepare this cash flow tracking. And now the projection of tracking needs to be prepared for a longer term and then updated weekly, if not daily, just to make sure we know exactly where we stand cash flow wise. So quarterly cash flow projections are used for planning, right? So if we know we're going into a period that's not so strong cash flow wise, we may want to project for next 3 months and see what our cash flow is going to be like. After that, we want to use that information and actually prepare monthly and weekly cash flow based on that, just so we can track our cash flow on an ongoing basis and respond to any pressures immediately. So cash flow tracking is for the organization or the department we're running overall. It doesn't need to be by individual program, right? Because this is just making sure we have money to pay all the expenses, make all the payments. Cash flow uses payment and receipt categories. Again, those are cash categories. They're not necessarily the accounts from our accounting software, right? They're not financial reporting categories. So for organizations with tight cash flow, projections and tracking reports should be provided to leadership, right? And this is because leadership has the ultimate responsibility for the organization's operations. And if we work in accounting, in finance, or even if we are program manager, the leadership still have the overall responsibility to make the right decisions and to make sure resources are there for our organization. So as much as it can be stressful for us, we have to remember it's the leadership's responsibility, and we need to give them a chance to be in charge of the cash flow. So we have to provide them those projections and tracking reports for them to know exactly where we stand. Okay, so let's look at cash flow tracking example now. Make it a bit bigger. Okay, so this one is just for a couple of months and it's for First Nation. Now you'll see here, it follows exactly the same formula we talked about. There is the cash in broken down to categories. There's cash going out. Then there is the monthly surplus or deficit. And then we add cash in bank at the start of the month. And then we get cash in bank at the end of the month, okay? But those are basically the categories here. They're whatever makes most sense for our cash flow tracking. And this is presented to program managers, this is presented to the leaders. So it needs to be concise and simple enough, yet meaningful, right? So just the main categories here. So for cash in, the First Nation gets funding from ISC and Health Canada, from CMHC, they get a tobacco rebate, sometimes some other receipts. For cash out, we have our usual categories, which is income assistance, payroll, some benefits, pension, mortgage payments, utilities, insurance, and so on and so forth. And you'll notice here that most of the numbers, they're not exact, right? So for instance, for ISC funding, I went too far here. I know the exact number, right? Because I receive a cash flow report from ISC, so I know exactly what's coming in, so I can use that. CMHC funding here is small enough that I can just estimate, and so is the tobacco rebate. Now, for the rest of it, because numbers fluctuate, they're not always exact, except for some numbers that I know are the same, like benefits here, it's the same payment every month, a loan payment or insurance, right? Then for the numbers that fluctuate, I would just use an estimate and round it to the nearest 1,000 or 100, whatever makes sense in those circumstances. But the idea here is I'd like to see the overall cash flow picture for these 2 months. And then if cash flow is tight, which it was kind of tight in December, you see there is deficit, hopefully I prepared this in advance enough and had an opportunity to look for funds somewhere to cover this deficit. If I prepare this in finance, again, very important to give to the leadership because it's their ultimate responsibility. There is enough cash flow, enough resources to run the programs. This spreadsheet is just an example that worked for this particular First Nation. It can look in many different ways. It really is about what makes sense to you when you think about your organization's cash flow. How do you have it in your mind? And then your spreadsheet can follow that. If you're not very proficient with Excel, pen and paper works as well. It's just gonna be more work on a calculator, right? But it's very helpful to keep some sort of a tracking report for your cash flow, especially at times of cash flow difficulties, or even when it's a little bit tight. If you know your funding is late and there's no other resources, definitely get into that habit. So now this is prepared for 2 months, and for December, because cash flow was tight, I would go in and update this weekly, right? Because sometimes the timing of receiving funding and the timing of making payments makes a big difference cash flow wise. Okay. So let's talk about different elements that affect our cash flow. Government funding. For the majority of our organizations, this is the most significant source of money coming in. And our goal here is to make sure we have all the information we need. Basically, we want to know how much money is coming in, when it's coming in, and we also want to make sure that nothing prevents it from coming in, that there are no funding halts, right? So some tips and tricks here is to set up GSIM's access to view the expected funding, right? If your funding is from ISC or Health Canada. We can also get on an email list with our funders where they send funding deposit confirmations, and they normally come ahead of time, so you know exactly what's coming. And also we can get on an email list for reports and requirements. So they send outstanding reports out, and we can see what's needed to be completed for the funding to flow without halts, without any issues. So if we're behind with our reporting, it's really helpful to focus first on whatever is causing funding halts, right? Because that's what's stopping the cash flow. So whatever is causing funding halts is our #1 goal, so that cash flow is eased. Establish a relationship with your FSO, Funding Services Officer at ISC, or if it's a different funder, then whoever is in charge of your organization there, because they may be able to override funding halts. They have quite a bit of power that way. If you have a good communication, you explain what the reasons are for you being late with reporting and your cash flow difficulties, they may work with you to help out. They may also be creative and provide additional funding. So what I've seen before for programs like income assistance, they really have a lot of flexibility for cash flow, and they can release additional funding immediately. So one of my colleagues had a good relationship with the FSO for their First Nation, And when they were in a big cash flow crunch because some other funds didn't come through, some other fund from ISC, the FSO was able to just release some more money from the income assistance program. And then that was adjusted in the following month when the other funds was released. So definitely have good communication and good relationship with whoever is in charge of releasing your funds. So let's talk about cash flow management for business receipts. So we're running some sort of a business operation, which most of our First Nations do, right? There is at least a community store, maybe a gas station. Sometimes they provide internet and telephone services. And sometimes we just own a business. We may own like a home hardware store or something like this, right? So in all those operations, it's important to keep your customer collection tight, right? Because as we know, some customers are slow with paying. So sales terms, your customers should be paying within 30 days. Terms with over 30 days is just not realistic for most of our cash flows. We don't want to carry our customer debt that long. Collection processes, reviewing accounts receivable listing, sending account statements to customers and calling to follow up on collections, that should be done at least monthly. Now, if your business is in a cash flow crunch, maybe that should be done even more frequently, right? Maybe your sales terms are even less than 30 days, or maybe you want to be on top of your collections even on a weekly basis. We want to set up for credit card and debit sales and pre-authorized withdrawals for our sales whenever applicable, right? Because then we receive the money right away. We never have to worry about collecting it after. Customers with late payment history can be put on COD, cash on delivery. And then for bad debt, we need to send it to either a lawyer or a collection agency and try to collect it. So this is all straightforward, just a quick overview or a reminder. So let's speak about cash flow management for payments, which is the most stressful part normally. So we have 3 types of payments. First type is payments that must be made on time. If we don't make them on time, we are in some sort of trouble, right? Payroll. Payroll has to be made on time. It's pretty straightforward. Income assistance, same idea, has to be paid on time. Insurance payments. So if you miss your insurance, your monthly insurance payment, the next month you get a notice that they cancel your insurance, which may not be an issue, or it may be an issue because, for instance, for CMHC funds into flow, you're required to have insurance for CMHC houses. Bank loan payments. Again, they can be delayed in some instances when you have a communication with the bank and it's a one-off, but normally we have to make those payments on time. Second category is payments that should be made on time, but can be late for 2 or 3 months. Now, this is of course not a recommendation. We never want to be late with any of our payments, right? So don't say Elena said you don't have to pay your group insurance on time. Okay, but if we are really short in cash flow and we have to choose between making payroll or paying our pension and group insurance, then the choice is making payroll, just because people not getting paid, our workers not getting paid would get us into immediate financial trouble in our organization, right? So for pension and group insurance, we can be late by 2 to 3 months, after which we start receiving reports. They start sending letters to ISC. So we have to plan to catch if we're late. Utilities and internet. So with internet, it's a bit iffy because they do have the ability to turn it off for us, right? As soon as the payment is not received. But again, maybe we have a month of leeway there. For utilities, in particular with your hydro payments, they're not going to disconnect during the winter, right? So if you are in some sort of cash flow issues during the winter, you can be late. And it's good to have communication with vendors in that case and maybe set up a payment plan or give them an estimate of when the payment is going to be made. So payments that can be delayed, most vendor payments, unless you know there are vendors that absolutely would cut you off and you can't live without it, all your accounts payable, majority of it can be delayed. Now, when you do that, it's always better to communicate with vendors and make a payment plan, right? Most of them would rather take a payment plan, even if it's over a long period and small amounts, than not hear from you at all and not get paid. Okay, so this is all not fun kind of things to do. And hopefully most of us don't have to do this on a regular basis. But when we have to do this, it's important to remember that there is priority in our payments, and we have to make payroll and income assistance payments always on time. Okay, so let's talk about bank debt. So bank debt is there, bank loans are there to help us out with cash flow in our operations, but also equipment purchases, maybe buying a business, and in some cases housing, right? So there are three main types of bank debt of most of our organizations. The first one is a line of credit. And this is what is supposed to be there for daily operation. That's supposed to be there to help us with our cash flows, okay, daily cash flows. So banks may offer a line of credit up to the amount of our average monthly funding. So if my First Nation receives $12 million in government funding a year, the bank may offer up to $1 million in line of credit. So if your bank is very uptight and is offering you way less, maybe it's a good time to explore other financing opportunities. So line of credit interest should be around the bank's prime rate plus between 0.25 and 2%. So the bank's prime rate is the basic lending rate that's normally set up by the Bank of Canada. So it's a part of government policy, right? And as you know, when they talk about interest rate hikes, this is when the Bank of Canada increases interest rate. They increase that specifically the lending rate, the prime rate, and then all the banks follow in that. So they have this basic rate that's basically set by the government, by the Bank of Canada, and then they add some interest, some percentages on top of it, depending on how risky they consider certain industry or certain clients. For First Nations, again, I've seen line of credit rates anywhere between prime plus a quarter to prime plus 2%. So currently prime rate is very high. As you know, we had quite a few interest rate hikes, 6.7%. That's very high, right? And now for a line of credit, there is no set terms of repayment. So it's supposed to revolve, which means money goes in, money comes out as our needs are in operation. So normally on the first of the month when we receive our funding, our line of credit is completely paid off. And then as we go through the month and we make some payments, we make payroll, income assistance, and so on, we may be using the line of credit, so its balance may increase during the month. So second type of bank loans is equipment and business purchase loans. So those are normally loans with set repayment terms. So it would be anywhere between 3 years to sometimes 20 years of repayment, and you will have a set monthly repayment amount, just like for your mortgage for those loans. So those loans may come with what's called a fixed interest rate. So at the time of you taking the loan, the bank would be offering a certain rate that is fixed and is not going to change for long term. okay? Or they can come as the variable rate, which would be just like the line of credit, where the interest rate would change based on the lending rate that the government of Canada sets, or the prime rate. Okay, so now with these term loans, they really need to be used wisely. Their interest rate, if you work with one of the big banks or any commercial bank, the interest rates are pretty reasonable. And we just have to watch that the term of the loan, how long the repayment is appropriate for what we're buying, right? And for its cash flow. So for instance, if we're buying a business for our First Nation using a term loan, we need to make sure that the business can afford to make those loan payments, right? Because normally the idea is if we make an investment, that investment should be repaying the loan. Otherwise, it's more debt burden on our organization, on our First Nation, right? If we buy equipment, again, what's the appropriate monthly repayment that we can handle for paying for that equipment? And if that equipment lasts for 10 years, maybe that's a good term for a bank loan. And it depends on other things like the rest of our cash flow. Maybe we can afford to prepay a lot of it, right? So it all depends on what we're borrowing a term loan for. So interest rate for term loans is normally around between just the prime rate to prime plus 3%. That's what I see for First Nations. Again, it may be different with different banks. This is just an average that I see. And then finally, the third component of our bank debt structure is mortgages. So anytime we buy houses, we get a mortgage against the house. So with mortgages, banks are protected the most, right? Because say the line of credit, there isn't much protection to the bank because they can't withhold our ISC funding. It's just kind of based on trust that there is a relationship, we're going to be getting ISC funding and going in and out of the line of credit. For equipment and business purchase loan, again, the security is a bit unstable, because if we bought equipment and we can't repay the bank anymore, the bank will have to seize that equipment and sell it. And that never generates as much money as we borrowed originally, right? And same with the business. So they're not so secure. Now for mortgages, they're the most secure, because if you buy a house, that house is mortgaged to the bank. That's the bank's security, and that normally provides a stable security. Now, there is the housing on reserve and the reserved land that the bank can never seize, right? But in this case, they get ministerial guarantee from the government of Canada for everything we lend to buy, for building or buying houses on reserve. And CMHC participates in that guarantee as well, so they're pretty well covered. And because of that, they can offer way lower interest rates on mortgages. So now for mortgages for First Nations housing, I found throughout the years that CMHC tend to have the lowest rate for those mortgages. So anytime you're looking into getting a mortgage or refinancing some existing mortgages, definitely check with CMHC what their rates are. I've seen their rates lower by a whole percentage than commercial banks. But again, it depends on the time and depends on your actual situation. It's just really helpful to check CMHC every time your mortgage is up for renewal. Interest rates on mortgages are normally lower than the prime rate. They can be even half of the prime rate or less. Okay, so as a part of our cash flow management, we really should be aware of our current debt structure in our organization, because we want it to be effective and we don't want it to be too aggressive, right? So we want to review the current loans, their terms, and repayment amounts. What I normally do is I go through the last annual audit and read the related notes. If I have further questions, I may go into bank agreements and see further details. So are interest rates and repayment terms reasonable? If no, can we refinance? If we want to refinance, if we want to restructure our debt, it's always useful to approach our current bank, but also at least one other bank, because banks tend to offer better deals to new customers, right? They're trying to get you in first, and then they can tighten the conditions there. So security for bank loans. Every time there is a bank loan, there is some sort of security that the bank has. And what we need to watch out for is some loans are secured by trust funds. So our First Nation may have a trust with treaty land entitlement claim money, and some loans may require security with that trust money, and that can cause tension, right? Because that trust money may or may not be okay to be used for securing loans. So just watch what your loan security is, and if it's trust funds, keep that in mind. It can be a bit contentious. So is our line of credit limit sufficient for operations? If no, can we request an increase? Remember, with line of credit, ideally we want to have 1 month worth of our funding, right? 1 month worth of operation. So in case there is a funding delay, in case something happens, we want to be able to still operate without any interruptions. If our line of credit is always at its maximum and it doesn't revolve, it was likely used to finance losses or to buy equipment or a business, right? So instead of using a term loan for buying equipment, somebody said, oh, we have this line of credit, let's use that. And now what happens is there's no way to repay it now, right? Because remember, line of credit doesn't have set repayment terms. It's supposed to revolve every month. So in that case, you really need to speak to the bank about refinancing, about getting a separate term loan that will be repaid monthly with set repayments for whatever is making that line of credit not move, whatever is keeping it at the maximum, right? So we bought equipment in the past, if maybe we had losses, we had some significant payables, we can't go to the bank and say, okay, we need a term loan to term out this line of credit so we can slowly repay it. And then we want to keep that line of credit still in place because we want to have the line of credit for operations, right? So it revolves when we need it. So if you're in finance or have to deal with cash flow in leadership program management, it's good to read the bank loan agreements and just see what your loan purposes are, what their terms are, interest rates, security, guarantees, just to be aware of what the current debt structure is and what it does to your cash flow. If we have prior debts to vendors from accounts payable, so we can manage it through making payment plans with vendors, payment arrangements. And you know what? They're always happy to hear from us, right? Because they'd rather hear from us and take a long payment plan with small payments than not get paid at all. And we can also get a term loan from the bank to pay off payables, right? So that's also possible. Consider borrowing from programs and projects within the organization, right? So if we have a program that has significant amount of money and it's funded by ISC, actually our contribution agreement allows us to lend money between programs as long as there is a written agreement and a repayment plan between the programs. So let's look at some examples. So first, I want to go through the debt notes in an annual audit. So say I'm new in my position, or maybe it's a new organization for me. How would I know what sort of loans, bank loans and repayments that the organization has? I would go straight to their last audit And remember, for First Nations, those are public information, so they're available online. And I would go on their balance sheet in the first place, right? This is where all my assets and debt are. And I'm gonna try and see what loans they have. So for this particular First Nation, I can see there is demand loans here, right? 136 million, and it's in Note 8, there is information. And then there is long-term debt, which is all my mortgages and longer-term loans that are described in Note 12. And there's about 10 million of those. So I'm going to go straight to those notes. Okay, a little fast here. Okay, so we see that here we have demand loans, right, in Note 8. And in an audit, they have to describe all the terms of those loans so we can understand better what the debt situation is. So we can see that this First Nation has a smaller, relatively smaller loan from the Bank of Canada. Those loans called demand loan because the bank can demand repayment anytime. Now, the bank is in business of lending the money, so it's not in their best interest to demand repayment. But then having that option to demand repayment is just making sure that we always fulfill the conditions of the loan. So, and then this First Nation, in addition to the Royal Bank loan, they have Private Finance Inc. That lent them $136 million. And here we have some details. Okay, and in the details, it says that Royal Bank of Canada loan interest is very low, right? It's 1.43. And the private finance loan, on the other hand, has interest of prime rate plus 11%. So right now, when the prime rate is 6.7%, that interest rate is almost 18%. So when you think about on $136 million, 18% is a lot of money, right? And those are just interest payments. So is this a good debt structure? No, that's a bad debt structure, right? Because 18% on $136 million, that's what, 25 million, around that, just in interest payments a year. Not good, right? So let's look at our long-term debts. Those are the mortgages and the longer-term loans. So here we have CMHC mortgages, right? We have some other mortgages, maybe. We have some like a school bus loan, some vehicle equipment loans. So everything is pretty normal and pretty, you know, in a regular course of business. So if we look here, we can see the interest rates, and we can see the monthly payments, and we can see when the loan is due, right? So all this information is here for us to review the debt. Okay. So that's what I normally do when I just start working with a new organization, or maybe I'm new in the role. I review the debt structure through their audit. So now let's look at, actually still here. Let's look at the bank agreement example. So what normally happens when you approach a bank to get, you know, a new loan, to get maybe to restructure your debt, they would first give you what's called a discussion paper. And a discussion paper, it just summarizes all your debt options and all your loans in a really friendly way, so it's easier to read. So here I have a discussion paper for one of my First Nations. And you'll see we have a summary here. So there is $300,000 in line of credit, which is working capital requirements. Here it's called overdraft lending. They also offer a corporate MasterCard of $25,000. Then there is demand loan. So that's a term loan for 2.1 million. And the purpose is to term out completed capital projects and accounts payable. So here we had previous amounts owing to vendors that were unpaid for quite a long time. And to resolve that, we got a loan from the bank, a term loan, and use it to repay the vendors. Then we have another term loan here, and this is to pay out existing leases. So when we reviewed the current debt structure, some of equipment purchases were financed through leases rather than loans, and those leases had very high interest rates, so like over 20%. And the bank agreed to give us a loan to refinance those leases at a way lower interest rate. And then they also gave us an additional, what they call master line, which is almost like a line of credit type loan for future equipment purchases. So we could buy up to 200,000 in equipment using that loan, okay? So then if we keep scrolling down, it actually gives us information about each one of those loans. Okay? It gives us the interest rate, it gives us the monthly fees, it gives us repayment terms. Okay, so you'll notice for line of credit, for repayment, they put cash flows, meaning it just revolves and you have cash flows. Okay, MasterCard is pretty straightforward. So the payables loan for 2.1 million, you see here that the interest rate, they give us two options. So we can get a fixed interest rate, and at the time that was back in 2020, it was a low rate of 3.39%. And then our monthly payments on a 5-year term would be $12,000. Or we could have a variable rate, which would change as the interest rate set by the Bank of Canada changes. And then in that case, our interest rate would be a bit higher in this case, sometimes it's lower. And then our monthly payments would be around $13,000. So we had that choice. And so here they say to be repaid over a maximum of 20 years. And now when you see here a 5-year term, but the loan, overall loan term is 20 years, what that means is the interest rate is fixed for 5 years. And then it is reviewed and the new interest rate is set based on the the environment, the economic environment at the time. So my overall repayment term is 20 years and my interest rate term is 5 years here. And then facility number 4 here, which is the lease repayment loan. So it's a 3-year loan, and again, they give us options of a fixed and variable interest rate. And you can see they're pretty reasonable interest rates, right? Compared to the 20% we were paying on leases. So here it's 3.32%, right? And then we have our monthly payment amounts, okay? And then it's, the last one is the equipment line. So here, again, they have the terms and they want to be repaid within 5 years. And the interest rate is set here. I guess most of the information is here that we need. Okay, so now in this document, they'll also have conditions that we need to fulfill before they release the money. And some of them are just very standard conditions, but some of them, you know, we need to read through and understand. They would also have security, right? So remember how I said they can use our TLE trust as security. This is where it would say what our security is. So here the security isn't, you know, an issue. It's just the normal bank security. And then they have our reporting requirements. So they're telling us when they want to get the annual audit and what else they want to get, okay? And of course, because it's a bank, They won't do anything for free, so there is fees to accept this new refinancing arrangement, which are quite high, $15,000 here, but it was worth it for this First Nation. And then there is annual credit renewal fees. When they give us those fees, we can attempt to negotiate with them. Sometimes it's successful, sometimes it's not. And the rest of it is just legal language here. So it is important to read those agreements. It is important to understand our existing debt, and if we're refinancing, to fully understand what the new debt is going to look like. And if there is something we don't understand, we're not bankers, right? We're not investment professionals, and we're not expected to understand everything in a bank agreement exactly. So we may ask questions. So we would ask questions from the bankers, but it depends on the trust level. Sometimes we trust them to explain it well to us and tell us what we should watch out for. But if we don't, if it's a new bank, we don't have the relationship yet, I would send it to our lawyer, and I would ask our lawyer to point out what may be an issue, and maybe to our accountant, maybe to the auditor, because they see those agreements all the time, and they can point out, look, this interest rate is a little too high. Or the lawyer can say, you're securing this loan with your trust money. Are you sure that's going to go well? Right? So definitely very important before this gets signed to understand what we're signing, just like when we sign a mortgage for our house or a car loan, right? Okay. So the last thing I want to bring up here is unique opportunities, unique financing opportunities for First Nations. Just gonna move Zoom things here. And so this is just a list of some of the opportunities. It's not all inclusive. New opportunities always come up. And it's good to network with other First Nations and with your tribal council and all sorts of other organizations, and just see what other people are doing, because there's always other opportunities. Sometimes what I do is I just Google financing opportunities or loans for First Nations, and all of a sudden something new comes up. There is a new government initiative. So it's good to be aware of what's available. So most of you have heard of FNFA, First Nations Finance Authority. So they offer low-rate long-term financing for member First Nations. The current long-term lending rate is 4.25%, which, remember, our prime lending rate is 6.7%. So this is a very low rate, right? Now the loan term is 10, 20, or 30 years, and loans are normally based on own source revenue. So if you're considering an economic development project, infrastructure investment, anything with significant amounts, you definitely may want to check FNFA. I'm going to tell you right now, commercial banks aren't fans of FNFA. So if you talk to your banker, you're going to hear all sorts of stuff. And that's just because FNFA may put them out of business, right? Not many commercial banks can offer such low long-term lending rates. My experience with FNFA has been very good. And what they did to the market, to the banking market, is all of a sudden commercial banks are offering long-term loans with low interest rate just to compete with FNFA. So I think they're a really good thing for First Nations. Then we have Community Economic Development Fund, or CEDF. So they offer loans, including forgivable portions for business projects by First Nation communities or organizations. Their interest rates, just watch them, because sometimes they're higher than your commercial bank rates, and repayment terms may be aggressive. Okay, so I find that They have the most aggressive interest rates and repayment terms as opposed to even commercial banks. However, the criteria for qualifying for financing is way easier than with commercial banks. And if you make all your payments on time, you have a forgivable portion of the loan. You have a grant in there, which can be very attractive. There is also Ontario Financing Authority Aboriginal Loan Guarantee Program, and that provides a provincial guarantee for a loan to finance a portion of equity investment, about 75%, in an eligible project. I just copied it off their website, that's why it doesn't sound as good, but the eligible projects are all related to electricity infrastructure projects, including renewable energy infrastructure in Ontario. So if you're considering participation in a wind, solar, maybe like a hydro project or any sort of electricity project, if maybe one is built around your First Nation, the government would actually guarantee a loan to invest in that project, which means it's pretty much 100% that you will get that loan, right? Once you get government guarantee. And it could be a very lucrative investment for a First Nation because most of these projects pay out semi-annual, annual dividends in significant amounts. Okay, so definitely check that out if that's applicable. Indigenous Economic Development Fund, so economic development and construction project grants and loans for First Nations in Ontario. And then finally, we have CMHC for mortgages. Again, I find that their interest rates are the lowest almost at any point of time. So definitely check them out when you need a mortgage. Okay, thank you for your time.